Hey everyone, as I've mentioned in a couple of videos recently, it looks like the Fed has changed its tune. They said they're going to increase their focus on jobs and unemployment, the second part of their dual mandate, as they set their rate policies. Then on August 2nd, the July employment numbers came out and the unemployment rate rose by 20 basis points to 4.3%. At that point, it became very clear the Fed is almost certainly done raising rates and will likely begin reducing the overnight rate in September. Wall Street has already responded and the 10-year Treasury has fallen under 4%, and the real estate investor buzz has already begun. I can see it, feel it, sense it. The market is beginning to turn. The investment climate is thawing. It's almost like the combination of Chairman Powell's commentary together with the jobs report was a trigger, the gun going off at the start of a track event. Not just any track race. In my mind's eye, we just kicked off the 110-meter real estate hurdles. The starting gun goes off, the athletes sprint down the track, then they start jumping over obstacles. That's my visualization of where the commercial real estate market's going. Investors sprinting down the real estate track to find properties, get them financed, get them under contract, complete the diligence process, get the deal done, get it closed. Some investors were ready to go when the starting gun went off. Others, they're already stumbling over the hurdles. But in the end, they're all competing to get the deal done. They're all chasing their gold medal deal. Over the last couple years, since the Fed started raising rates, the one thing I heard repeatedly was that investors weren't interested in taking on negative leverage. If the cost of debt was higher than the yield on the property, prospective buyers held back unless they saw a clear pathway to boosting the property's yield. But I think the math has changed. The 10-year is back under 4%, and lenders are becoming increasingly convinced that the Fed is done with its tightening cycle. So lenders have begun to rein in their spreads, and the cost of debt capital is going down. At the same time, over the last couple years, property values have edged lower and cap rates have risen. Enough so that the spread between the 10-year Treasury and the average cap rate has widened to where deals make sense to investors. If you look at the overall average commercial real estate cap rate, it's up by about 90 basis points compared with 2022 to 6.7%. That's about 290 basis points over the 10-year Treasury. The cap rate spread over the 10-year is widest for office properties. And while there's considerable uncertainty about the outlook of the office sector in general, the opportunities presented by the nearly 400 basis point spread over the 10-year is starting to capture some investors' imaginations. The property type with the next widest cap rate spread is industrial. But we need to take that with a grain of salt. The term industrial covers a wide swath of commercial property subtypes, so there's a significant cap rate range. Nonetheless, industrial property cap rates have generally stabilized, and the declining rate on the 10-year Treasury has injected some new opportunities for this property type. Retail properties have an average cap rate of 6.8%, about 300 basis points above the 10-year. With retail property vacancy rates and rent growth near record performance levels, falling interest rates will make these assets even more attractive. The yield spread on self-storage has also opened up, reaching 280 basis points after it was pinched to just 180 basis points in 2022. The emergence of storage as a mainstream commercial real estate asset class over the last 10 years continues to draw capital, and the widening of the yield spread could boost demand for these assets. And finally, the spread between the average apartment cap rate and the 10-year has reached 200 basis points, the magic number. In conversation after conversation with investors, I've been told that this spread has to reach 200 basis points for deals to pencil. Well, we're there. And I anticipate the competition for assets will heat up quickly. At the beginning of the year, there was near record capital targeting commercial real estate waiting on the sidelines. But in the last couple months, we've seen some significant transactions come through the pipeline, and the dry powder awaiting deployment has begun to draw down. The race to place capital has started. So take a moment to consider. Looking forward, do you believe the Federal Reserve will lower rates? Do you believe that rate reductions will help spur the economy? Do you believe that combination will be good for commercial real estate demand? Do you believe competition for assets will increase? As you ask yourself those questions, I want to remind everyone to consider the longer-term outlook and to keep your eyes on the horizon.